Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon, all. Ira Epstein of Linn & Associates with your metals market update for this Wednesday, the 5th of July, 2017, just after 2:30 p.m. Central Daylight Time. I'm refreshed. I'm back from vacation, so now we can talk. You know, the big event, obviously, that just took place yesterday was the ICBM launch by North Korea of a missile that they claim is very capable of two things: carrying a nuclear warhead, number two, hitting Alaska, maybe Seattle. Now, we have been told over and over that they're years away from that. Hogwash. They're doing it. Thing went up 1,700 miles, and if you bend the trajectory, they're saying it might have got there. The tricky part, clearly, is could it carry a warhead? As it re-enters the atmosphere, would it fall apart? What would happen? I'm not saying I'm an expert on that, but I read, and what I'm reading isn't good. And what are the choices? Well, that's what's going to be in the metal markets. That's why I'm bringing it up. You've got the G20 meeting. Today, literally right now at the Security Council, they're meeting. What are they going to do? They've got to shut down trade between China and North Korea. Believe it or not, the trade in the first part of the year went up like 30% between China and North Korea, maybe 40%. So when China's saying they're trying to do things, hogwash. They can't do exports or imports. They got to shut it off. Shut it off, you stop the money flow. Shut it off, the people complain. They're not getting foods and other items they might need. Will they do that? That's the dilemma that you've got. Then, of course, President Trump is going to meet Mr. Putin. What fireworks come out of that? So the gold market, and that's what I'm leading to, late in the day, is still climbing. It did not settle this much higher. The market was lower than this, but it is coming up as the market's trying to figure out what does it do with all these events that are going to happen this weekend, including the employment data and the private payroll numbers that we're going to start getting tomorrow and Friday. So you've got a lot on your plate, and you've got to take it all in. Now, as we go to the gold market on a weekly chart, this market is breaking out to the downside. This is not bullish in any manner, way, shape, or form. I was hoping to see the market do a much better job of holding at 251.30, and I'm the first to tell you, if you were to tell me that North Korea launches an ICBM missile and the gold for the week is down $16, I'd be surprised. There you are. So, until the market turns itself around, it's bearish. It's that simple. You've got a pattern of lower highs on area charts of closes, certainly lower lows, bearish. When you just look at this chart, if you're trying to get bullish off of it, you can't. The market has not held up. That's the important event. When you go to the swing lines, you've got a pattern of lower highs, lower lows. That is bearish. When you take a look at the moving averages, the 18-day moving average in red closed underneath the 100-day. That is bearish, not bullish. What did the market do when that occurred? Market came down, but you didn't have the crossover. The crossover is today, and you didn't make a new low on a closing basis. There's nothing friendly about that. These rallies are probably going to have formidable resistance in the 1251 level, which ties together with that other chart that I just showed you. I'm going to take you back here just to show it again, the weekly, of 1251. So that's a pretty big number, and that's the number that if you're wondering where does the market fight a battle, if it can get up there, and I'm not saying it will, but if it can get up there, that's it. I saw today that Merrill Lynch came out, and they're looking in the second part of the year for gold to still rally, and rally smartly. So there are people out there and big bankers that are talking about that. Okay. When you look at the Bollinger Band, you got down and you held it. Now, what's the importance of Bollinger Bands if you're new to these videos? The importance is that when you look at them, you understand that the market trades within them 95% of the time. Another way to interpret that is the first time you get up to the top or the bottom is probably where the pros are taking money off the table. Assuming they were bullish, that's where they're coming out of their positions. Not all necessarily. I don't know what they're doing, but that's the theory. Same thing on the downside. You hit it on Friday, you went through it. Well, now you're back over it. So if you didn't do that, you're out some money. Doesn't mean the market won't fall tomorrow. I'm just telling you what the theory is behind it, and I think that's very important. When you look at the slow stochastics, they're embedded. Now, embedded means that the K and D lines are both staying under 20 for at least 3 days in a row. Day 1, 2, and here you've got it on 3. So you've got your embedded reading. It happened today. So now the key is, if the red line gets back over 20, the odds favor that the market's going to make a run for the 18-day average. That's just not intraday getting over. It's got to settle over it. Now, sometimes you settle over it, and the next day you can fall back under it again. That's sometimes. More times than not, that's also a sign the market's losing its momentum, and it's going to do something. Here you had your embedded reading, and when you lost it right through here, notice how price, and they were down in this area right here, went to that 18-day average. So often is the word I'll use, not all the time. When we come to the ETF of GLD, embedded reading, bearish. Bearish crossover today, 18-day average of closes over the 100. Lower highs, lower lows. So on rallies, until you lose the embedded reading, the trade is bearish. You know, I wrote a long-term gold report. Didn't say buy or sell. I needed certain events to happen. They haven't happened. They may happen on the longer-term charts. They're not there right now, and that's the important thing. And if they're not there, you wait and see what if they even arrive. May never happen. When we come to GDX, the miners, first thing I can tell you is you're just oversold. Unlike the futures and the ETF of gold itself, you've got the lower highs, lower lows into the lower Bollinger Band. That's where the pros were taking some money off the table. That's at least my opinion. The gold-silver ratio hasn't backed off yet. On this rally, it's still continuing to gain on the silver, and that's in part because we're seeing economic reports and data that keeps coming out. In the U.S., we had some numbers again today. They're just not all that bullish, so that becomes the problem. The good news is China's doing better than we thought it was, but when you look at silver, that's not so bullish. This is a market that got up to the 18-day average, failed, so you got a higher high, a lower low pattern. Market went down today. It's right now at 1,600. The lower Bollinger Band, 1,604.5. This is where I think the pros are doing what? Coming out of short positions. I'm not saying you buy it. I am saying that's where I think they're covering out of their short positions. The copper market, we talk about a loss of a bullish embedded reading. It happened on the close today. When that occurs, it does not mean the trend has to end. What it means is price and the 18-day average are going to probably make a run at each other. When you have the 100-day average over the 18, I'll take the 100-day average as the near-term objective. The difference between them is minor now. It's about 35 points, so it doesn't matter. Platinum. The platinum market went up while I was gone to the 18-day average of closes. Bang, it falls apart again. So this number, and this is very important, it's telling you that's your resistance point. You are oversold, not embedding. But again, I think at that lower Bollinger Band, traders are pulling money off the table. In the palladium market, the trend is down. You've got now lower highs, lower lows. I'm the first to again say you get to that lower Bollinger Band and you got to be careful. That number comes in right now at 825.90. You got to 826.20. So you're knocking on the door in an oversold condition. Today's high is going to be very important for tomorrow and Friday's action. Whenever I see an outside day down, if the market takes that high out in the next 2 trading sessions, I'll call that a bear trap, and I flip it over and look to see where it might go, and that could be back to the upper Bollinger Band, so we'd see what would go on there. In the dollar index, well, the dollar index is interesting in that it had fallen apart, got a bit of a rally while I was on vacation. I wouldn't be surprised if you try to make a run up to the 18-day average of closes as the market works off, current tense, working off an oversold condition with the stochastics in oversold territory. So when I put that all together, okay,
I'm not that excited about the market one way or the other. I can't get away from the fact that you keep breaking on the energy markets and nothing there seems to be doing them an awful lot of good. I'm surprised the stock markets have held up given the energy sectors have been in some problems, but still part of the July 4th holiday. With that in mind, more research center. Let me tell you what I use them for. They look at seasonal trades. Now, what do I mean by seasonal? Buy on this date, get out on that date. It's worked X% of the time. Historically, they track trades as long as they've worked out of the last 15 years, 12 times out of the 15. If they don't win that amount of times, now win is the wrong word, if they don't perform that way in that period, they back away. Is this a good tool on its own? No. It's a good tool with other tools. It's a real nice tool for a fundamental trader as well because they understand you plant the grain as an example. You're watching over your shoulder. How's the weather doing? How much acreage? Export business, dollars, what goes on at a point in time. Give you a trade for an example. This is the time of year where we're all looking for the hot weather, yet the seasonal and natural gas is down. Most people don't realize that. They explain this all. And how do you get it explained? Well, they offer you a 2-week trial. You're going to use your email address and then an ID. They'll present that. You get 2 months of looking at the seasonals. Right now it's July and August. You get to look at them both on a straight futures basis and spreads. And they explain the differences in good writing all through the site, by the way, and it would look something like that. If that isn't enough, you get to work with their interactive charts for bull years, bear years, neutral years, and these are how a lot of their reports look. I'd like to give you 2 weeks access to it through them. Give us a call, 866-973-2077. You go to iraepstein.com. You can get it there as well because you'll see our carousel of free offers. You can click up here if you're watching me on YouTube. Click on that icon. It'll work. And, of course, underneath me it says, click here for Ira's free offers on a number of websites. Do so, and we'll take it from there. I'm Ira Epstein. Thanks for watching. By the way, if you have friends that you think would be interested in what we do, we'd love you to tell them about our site. Let's drive traffic to it. Not our website. Go to the YouTube. I'm more than happy with that. You have a good day.